Welcome back to Smart Stock Sam, the channel where we cut through the noise and hand you the forensic truth behind the most contested stocks on the market. Today, we are cracking open one of the most explosive debates in fintech right now, SoFi Technologies. Muddy Waters, one of the most feared short sellers on Wall Street, just dropped a 28-page report calling it a financial engineering treadmill. Meanwhile, institutional heavyweight Mizuho is calling it a once-in-a-generation buying opportunity with a $38 price target. Two massive names, two completely opposite verdicts, one stock. By the end of this video, you will understand the four critical pillars holding up, or threatening to crush, the entire SoFi thesis, and you will have a real playbook to monitor the risks going forward. Stay locked in, because if you hold SoFi or are even thinking about it, what comes next could completely change how you see this company. Now, to understand why the market is this divided, you need to memorize four numbers. First, there is a $312 million loan transaction that critics say is actually unrecorded debt disguised as a sale. Second, $1.8 billion in what the bears call paper gains, internal model valuations that have never been realized in cash. Third, a charge-off rate discrepancy that is almost impossible to ignore. SoFi reports 2.89%, but Muddy Waters says the real economic damage is closer to 6.1%. And fourth, 58.3 million shares extracted by management through sophisticated financial contracts while retail investors hold their bags. Even if just one of these four pillars collapses, we are not talking about a dip. We are talking about a fundamental repricing of the entire business. But before we dissect each one, we need to understand the two radically different stories being told to Wall Street right now. On one side, you have Muddy Waters betting on credit decay, alleging that SoFi is using accounting maneuvers to hide the fact that their borrowers are quietly falling apart. On the other side, Mizuho is playing the institutional defense, arguing that SoFi follows standard bank disclosures, is primed for massive EBITDA expansion, and is now building momentum with a MasterCard stablecoin partnership. One camp sees a black box stuffed with hidden risk. The other sees a regulated moat with serious upside. But here is what almost nobody is talking about. Both narratives hinge on a single $312 million transaction that could trigger a $1 billion restatement. So let us go there. In the third quarter of 2024, SoFi moved $312 million in loans to JP Morgan. SoFi calls this a true sale. Cash comes in, loans leave the balance sheet, revenue gets booked, clean and simple. But Muddy Waters dug through state-level filings and is alleging that SoFi actually retained the risk on those loans. Now, think about it this way. If you sell your car but promise the buyer you will cover every repair for the next 5 years, did you really sell the risk of that car breaking down? The FDIC and OCC have not forced a restatement yet, but forensic auditors are waving a massive red flag. And here is why the stakes are binary. If those loan transfers get reclassified as secured borrowing instead of a true sale, it could wipe out up to $1 billion in cumulative EBITDA going all the way back through SoFi's history. That would mean their Tier 1 capital ratios, the safety cushion regulators care most about, have been fundamentally overstated. Now, the bulls have a fair counter. SoFi is a chartered bank. To deliberately misclassify debt as a sale, management would have to bypass formal true sale legal opinions and survive direct scrutiny from the Federal Reserve. That is an enormous institutional risk. But could it happen? The chances are slim. But is slim the same as zero? Absolutely not. And in a market this unforgiving, slim is not comfort enough for a lot of institutional players. Now, while the sale debate is about the past, there is a hidden metric about the future value of SoFi's loans that changes the entire picture. This is what we are calling the benchmark Duel. When SoFi values its student loan portfolio, they use a specific discount rate to calculate what those loans are worth today. Muddy Waters argues that SoFi's rate of 3.89% is far too low and should instead be pegged to the 10-year Treasury. But here is the important clarity. SoFi's student loans have a weighted average life of roughly 4 years. Standard regulatory practice says you match the benchmark to the duration of the asset. Using a 4-year SOFR benchmark is not just aggressive, it is technically the correct gap method. The bears are calling it creative accounting, but the math says it is compliant. The problem is that being compliant does not make you immune to market volatility, and that creates the next time bomb. SoFi currently sits on $1.8 billion in cumulative fair value adjustments, $1.1 billion in personal loans, $723 million in student loans, all marked as Level 3 inputs. And Level 3, in plain English, means internal models. Not realized cash, not market price sales, just internal math. Now ask yourself, what happens if that 4-year SOFR curve spikes even slightly upward? SoFi would be forced to take an immediate, non-cash hit straight to net income. They are essentially leveraged to the interest rate environment. If the Fed keeps rates higher for longer, that $1.8 billion in equity could start evaporating before SoFi ever sees a single dollar of it. And that is before we even talk about whether borrowers are actually paying back their loans. This brings us to possibly the most controversial chart in this entire debate, the charge-off delta. SoFi's headline charge-off rate is 2.89%, which looks outstanding compared to traditional banks. But Muddy Waters alleges that SoFi is engineering that number by selling off delinquent loans at day 119, just 1 day before the 120-day threshold where loans are officially classified as a charge-off. When you fold those sales and additional adjustments back into the calculation, the true economic decay rate may be as high as 6.1%. If that is accurate, SoFi is not outperforming the credit cycle. They are masking it, and when those masked losses start piling up, they hit a trigger that can shut down SoFi's most profitable engine entirely. Legendary investor Steve Eisman, the man who called the 2008 financial crisis in real time, is sounding the alarm on exactly this. One of SoFi's major securitization deals, the SCP 2025-1, just hit a cumulative net loss trigger of 2.97% against a target of 2.60%. Here is why that matters more than it sounds. Once that trigger is breached, SoFi stops collecting the profit spread on that deal. Every dollar of cash flow gets diverted to make investors whole first. The financial engineering treadmill stops, the margin vanishes, and if this kind of trigger breach spreads across multiple deals, SoFi transforms overnight from a high-growth fintech story into a company just trying to pay back its own backers. But while the market is processing all of this, what are the insiders actually doing? CEO Anthony Noto made headlines by buying $500,000 worth of SoFi stock, a clear signal of personal conviction that the bulls ran with hard. But zoom out for a second and look at the scale. That $500,000 purchase represents just 0.86% of the total value management has moved out through 58.3 million shares via what are called prepaid variable forward contracts. These are sophisticated instruments that give executives liquidity and tax deferral without the optics of a traditional stock sale on public filings. The bears argue that while Noto is buying for the cameras, the sheer volume being moved out the back door tells a completely different story about long-term conviction. And all of this sits on top of a demographic vulnerability that almost nobody is pricing in correctly. SoFi's core customer is the Henry, the high earner, not rich yet. White-collar professionals making 6 figures with a debt load they are trying to refinance. Historically, this is one of the safest demographics in consumer lending, but here is the scenario that should keep every SoFi bull up at night. What happens when you combine a sustained high interest rate environment with accelerating AI-driven white-collar job displacement? Muddy Waters estimates up to 15% of the professional roles held by SoFi's borrowers could be at structural risk. If the lawyers, software engineers, and mid-level managers who carry SoFi loans start losing their jobs in a real wave, SoFi becomes ground zero for a credit default cycle that their internal models have never even contemplated. Could that actually happen at that scale? The probability is low, but it is not zero. And in credit markets, tail risks are exactly what destroy lenders that feel invincible. So here is the synthesis. On one axis, SoFi holds a real defensive advantage on the technical and regulatory side. Their accounting is largely standard for a chartered bank. The FDIC and OCC have not intervened. The benchmark methodology is GAAP compliant. But on the economic reality axis, Muddy Waters has successfully demonstrated that the numbers beneath the surface are far riskier than the headline figures suggest. A 6.1% real charge-off rate and 30% management dilution are genuine economic pressures, regardless of whether they are technically legal. The question you have to answer for yourself is this: are you investing in a legal structure or an economic outcome? If you are holding SoFi right now, here is your forward monitoring playbook. Watch securitization triggers first. If the 2025-2 deal breaches its cumulative net loss limit, the cash flow story is over. Track the 4-year SOFR rate obsessively. Even a modest spike forces a painful remarking of that $1.8 billion. Monitor what the private credit giants like Apollo and Ares are doing with their loan purchase programs. If they slow redemptions, it means the market for SoFi's loans is quietly freezing. And stay on top of macro employment data, especially white-collar layoffs. If the Henry demographic starts cracking, the entire thesis unravels from the foundation up. Now, before we wrap this up, a quick but important reminder: nothing in this video is financial advice. Smart Stock. Sam is an educational and informational channel. I am not a licensed financial advisor. Everything discussed here is based on publicly available research, third-party reports, and publicly filed documents. Always do your own due diligence and consult a qualified financial professional before making any investment decisions. Investing in individual stocks involves significant risk, and you could lose part or all of your investment. With that said, here is the final verdict. The comparisons to outright fraud like Enron are hyperbolic. SoFi is a highly regulated, chartered bank. It is not going to zero tomorrow. But the economic reality is that SoFi is running on a high-velocity treadmill. It is a high beta bet on the survival of the private credit cycle, the resilience of the American professional class, and a sustained improvement in the interest rate environment. Any real stall in loan sales, any spike in defaults, or any sustained rate pressure will rapidly convert $1.8 billion in paper gains into realized losses. It is not fraud. It is a leveraged bet. And right now, the forensic evidence is on the table. Mizuho sees a buying opportunity. Muddy Waters sees a treadmill. The next round of securitization data will tell us which one is right. If you want to be the first to know when I break that down, smash the subscribe button and turn on notifications. The SoFi Divide is the most important story in fintech right now. And Smart Stock Sam will be right here when the next chapter drops.